Welcome back, investors, to Ticker Time News. I'm Adam. Thank you for joining me for the After Hours show. It is wonderful to be here. Sorry I missed yesterday. As many of you know, I have a condition called porphyria. It's why I'm in this wheelchair. And porphyria can, at times, cause me to get pretty sick. And yesterday was one of those days, so I do apologize for missing the live stream. I want to be here every day the market is open with you to talk about the market, to help you understand this market, and to help all of us become financially free and financially independent. So that's my goal. Sorry I missed yesterday, and that's why. So let's move on to today. It was a pretty messy day. The S&P 500 has fallen out of its channel. The Nasdaq is below its 200-day moving average, and it is technically in correction territory. So amid the anxiety surrounding rising interest rates, as well as some concerns about corporate earnings being mixed, and what has been a general de-risking effort in the market, we've got a lot of things to talk about today. One of them being Sofi. Yesterday evening, right after the market closed, Sofi came out with an announcement that they have been approved to become a national bank, and the stock went wild in after hours yesterday. So we're going to do a deep dive on Sofi and talk about what that means. Also going to do a deep dive on Microsoft's deal to take over Activision Blizzard and become the, I believe it's third largest gaming company in the world with this takeover of Activision Blizzard. We'll also talk about Gap getting downgraded and what that means for Gap, because retailers have been doing a pretty good job. I know in the market is de-risked right now, and it is taking risk off the table. So that's playing into it. Also, a deep dive on Morgan Stanley's earnings. Now, as you have known from several of our live streams, going back to last Wednesday, when Jefferies came out and they missed horribly on a few items in their earnings report, that was a crystal ball, and that led to a snowball effect. JP Morgan, Citigroup, all doing bad. Morgan Stanley, however, I believe has a more diversified income stream, and that's why Morgan Stanley was not affected as badly as some of the other big banks out there. And then we'll end up today talking about catalyst for tomorrow. So in this current market we're in, there is a growing divide between growth stocks and value stocks. And wouldn't it be great to know what the top 10 stocks are in categories like value, growth, dividend, and momentum? Well, that's exactly what we put together to help investors and to help guide investors towards the best companies out in the market today. So we have uploaded our top 10 stocks list for each of those 4 categories. That's over 40 high quality stocks ready to choose from, and they're constantly updated, so you'll always have the best names available. So click the first link in the description to become a member and get instant access to those incredible top 10 list of value, growth, dividend, and momentum stocks, and so much more. We've done the research so you don't have to. But of course, you can also do your own due diligence, and that is definitely the preferred route. Hello, Devin. How's it going? After 6 weeks of torture, yesterday started with my Activision Blizzard, ATVI, and ended with Sofi. If the market ever stops crashing, I'll be good. Absolutely. I hear you there. There were a couple that I've had in my portfolio since the beginning of the year, just a few weeks now, that started off doing really well, Samsara being one of them, and it's just started to fall now, and it looks like we could be facing a market where we go into a correction. This is very possible that we are just now in the beginning part of a correction in the market. Like I said at the onset, the Nasdaq is officially in correction territory, being down 10% from its highs. And on the screen here, this is the SPX, which is the S&P 500. And if we scroll out here and look at this trading channel, we have to go all the way back to March of 2020 to get out of this channel in a substantial way. We could go look here at October of 2020, where it barely, for about a day, I believe. Let me get in here on October. Yep, on October the 30th, for one day, the S&P 500 dipped out of that trading channel, but it closed right on that support trend line there. But if we look at where we are today, all of these months that we've just been going up and to the right, if we look at where we are today, we are definitely outside of and closed outside of that support line for the S&P 500. This definitely puts a bearish tone on the S&P 500 and the market in general. And with the Nasdaq being below its 200-day moving average, we're definitely in a area of pain. And this pain could last for several weeks before we get to any sort of bottom, because if we go back over almost 2 years, just shy of 2 years, going back to March of 2020, we haven't really seen a big correction, a 15-20% correction in the market since then. It's just been up and to the right. So we are definitely due for some pain, overdue for some pain. The market was incredible last year, incredible in 2020. Now in 2022, it looks like we're setting up for some pain. But I did see some research recently about cycles and how cycles are different when you have a Fed, a central bank, when they are lowering rates versus when they are raising rates. And surprising to me, during the years where the Fed central bank, where they were raising interest rates, the market actually performed better. So it's going to be interesting to see how this plays out this year. I am a believer on certain themes and on value this year. And I know on the value aspect of it, Kathy Wood is completely different. She says we're in a value bubble right now, not a tech bubble. Which I see kind of counterintuitive for how the market's reacting, but we'll have to see how that plays out. It's scary, but I'll be standing at the front of the ship screaming at the storm. Screaming, get the iceberg out of the way, move it. Yes, I'll be up at the front too. I am not leaving this market. This market is, there's no, okay. There's 3 ways to make money in America. And as a matter of fact, before I went live today, I was listening to Dave Ramsey, and he's always got interesting things to say. Over the years, it's kind of been repetitive with what he says, but 3 ways to become a millionaire in this market. And this is something I've believed for several years. It was just refreshing to hear him mention at least one of the ways. You either own a business. That's one way. The second way is to own stocks, which is kind of like owning a business. When you own a stock, you do own a portion of the business. You're just not in the operation aspect of the business. So that's 2. And the third is with real estate. So you either own a business, you own stocks, or you own real estate. Those are the 3 ways to truly build wealth in America. That's my personal belief. Dave Ramsey was mentioning the stock market and owning stocks, but specifically in IRAs, Roth IRAs, in a retirement type fund to save up for retirement. That was one of his things. But he's got a new book out. It's Baby Steps to Become a Millionaire. He actually interviewed 10,000 millionaires. And a couple of the baby steps that he offered, one is get $1,000 in a savings account. That's step one. Step two is to pay off your debt except for your mortgage. And then step three is to start investing in retirement type vehicles, buying stocks, and let that compound and grow until you're ready to retire. And basically, that's his steps to becoming a millionaire. Now we're going at it we're going at it a little in a different way, but yeah, I mean, it works. The 10,000 millionaires that he interviewed are 10,000 people that have over the years gone through Dave Ramsey's different programs and have become millionaires, basically following that formula. So yeah, I thought it was insightful, but yeah, for me personally, it's those three things, and us being in the stock market, investing, that's obviously one of the three ways to build wealth that can become generational wealth for our children and for our families in the future. All right, let me dive into Walmart here. Walmart. I've got Walmart on the mind because in the Catalyst Watch video, I said Chevron and Walmart were my two Dow stocks that I figured would do the best this week. We'll check in on them and see how they're doing. But here's a real brief overcap of the market. So Wall Street definitely extended losses today. We can totally see it on the chart here with the S&P 500 falling out of its trading channel. It was a very volatile section. Stocks did extend losses after a sharp drop in yesterday's session that took the three major indices to multi-week lows. I mean, if you look at today's low, we would have to go back to December the 20th to be at this level. And it didn't close. If we look for a closing day, we would have to go back to December the 3rd to find a day in the S&P 500 that closed this low. So all the way back to the beginning of December. And there seems to be this concern over higher yields, and I think a lot of people are mixed on earnings because with the big banks reporting already, or a lot of them reporting already, a lot of them came in and had problems. And a lot of the problems came from fixed income trading. That fell hard. And that was one of the big reasons why JP Morgan, Chase, why they had a problem. Jefferies predicted it. They were the start of it. The fixed income trading, it just sank. For Jefferies, it sank 49%. So the Dow Jones, it swung between gains and losses today and erased as much as 340 points. The S&P 500, it fell 1%, and the tech-heavy Nasdaq, it dropped 1.2%. Investors digested fresh earnings reports and a small decline in treasury yields. While I guess the odds are rising that the Fed's March rate hike may be bigger than the 25 basis points that we would be accustomed to. It's a possibility. I don't think it's likely. I don't think that the Fed would go that big, more than 25 basis points. But there's always that possibility. But I don't think they will. I think they'll stick to 25 basis points and And that'll take us from 0 to 0.25% to 0.25% up to 0.5%. So a half a percent there. So that's where I think it's going. Now, on the corporate front, profits from Bank of America and Morgan Stanley increased, while US Bancorp, they posted a raise in compensation costs. That's also something that hurt JP Morgan Chase. Also, Procter and Gamble, they raised their sales outlook. Of the 33 S&P 500 companies that have reported quarterly earnings results so far, nearly 70% have topped Wall Street's estimates. Now, I think this time around, I think earnings will do pretty well for most companies. But when we get to the second quarter, things may change a little bit. Companies that are going up against comparisons of big growth, big EPS, they may have trouble in the second quarter matching those big comparisons or comps. Meanwhile, though, both housing starts and building permit forecasts, they beat. They came in hot, they came in good, but it does point to a tight housing market. So, the housing market, right? Right now, as many of you may know, I'm in the process of looking for a house to buy. And when you're in a wheelchair, you have to be a little picky with the type of homes that you can buy. Unless you want to get fancy and put an elevator in to get to the second floor. And here in Northern Virginia, there's not a lot of one-story homes around that are in my price range, I guess I would say. Uh, Homes here in Northern Virginia, I think, live in a bubble. And I think that's just because of a lot of federal employees live here in Northern Virginia, which makes the whole area financially stable. Because working for the government, there's always money coming in. It's unlike, I think, many other places in the world, or in the U.S., not the world, but definitely in the world. But Northern Virginia, I think it's a bit of a domed, I don't want to call it a bubble. It's in a dome where everything is pretty stable, but that means costs are elevated. Now, I know when you live close to big cities like New York City, prices go up the closer you get to the city. But Northern Virginia, it's in this dome of its own kind of economy here. And it can really be different just one county versus the next, just, crossing that county line. Fairfax County is in Northern Virginia. Maybe you get down to go down 95 south a little bit, about a 30-minute drive, and the prices are completely different. Completely different. So, all right, enough about that. Let's look at Bitcoin BTC USD. It did fall yesterday. I was watching it, and it came in to that trend line again. So let me open this up. Now, we are past the death cross. The death cross is over. It was kind of funny. While the death cross occurred, and that was right here on the 14th of January, when the death cross occurred, Bitcoin actually was up 1.2% on the day. So, death cross lagging indicator just means we've already been in a downtrend, and we're either at the bottom, we've seen the bottom, or the bottom is really, really close. That's what I believe about it. And now Bitcoin is back here on this trend line, and it looks like it wants to try to sink below it. It looks like it's just below it, but it's on this area right here where there's a trend line, ascending trend line support, and there's a price action, price line support right around this $42,000 level where we are right now. But it looks like prices want to get back to where they were over a week ago, over here on January the 8th, maybe January 7th, maybe somewhere in there, where we had where they closed at 41,684 and 41,565. It looks like Bitcoin wants to get back to those closing areas again. So it's possible. I was hoping that Bitcoin would stay above this trend line and then just slowly creep up. And I got some excitement here on January the 11th and 12th, but then the 13th brought it back down flat. And here we are again, back on the trend line, just slightly below that trend line, just slightly below that 42,000 support. And if it breaks this and it continues in a downward trend, because I mean, you can see this thing has been trending down ever since that 69,000 high. The next area of support is down here at $40,000. Now, it is possible that we had a death cross. Now that Bitcoin could go down to 40,000, find its support area there, and then bounce. But a lot of the different charts that I look at for Bitcoin, they all point to a bottom is nearby. Whether that means we already hit it back here on, say, January the 7th, or we're about to hit it in the next few days. But they all point to being near a bottom. Right now, Bitcoin holders are accumulating right now, which again, that is a sign that we are near a bottom, because usually the long-term holders, they start to sell out some of their Bitcoin as Bitcoin starts going up, like it did back here throughout October. They were selling out on this rally all the way up. So there we are with Bitcoin. Let me just put volume in here so we can see. Volume has been rising over the past 3 days, which is good. Volume today was 15.2 million, with 15.1 million being on the average side. So Bitcoin only fluctuating, had a high of 42,500, a low of 41,100. With volume being that high, and Bitcoin only moving about $1,000 or so, that's not a lot of movement. So that's interesting too. I mean, to me, that shows that at least it seems as though there are more people stepping in to buy somewhat than to sell. Uh, with it being within 1,000 like that. It is down 1% now on the day. It is sinking a little bit lower right now. All right, let's look at Ethereum, and then I want to look at Cardano, because I think Cardano might do something special this year. Here's Ethereum. It's following the path of Bitcoin. It's just it's moving at a little quicker pace. So it'll have greener days, or it'll have redder days when following this path of Bitcoin. But Ethereum, it is right here along this trend line. I need to extend these lines out. But, it does have another trend line that it could fall to. So there really isn't something really strong holding it here. And if we went down, extend that out, well, that's right about, I guess, 2,900 to 3,000. That could end up being a bottom for Ethereum, potentially. So just keep an eye on Ethereum. It is down 15% year to date after being up over 400% last year. So watch that. We are in a area of de-risking, and with the volatility of cryptocurrency, it is definitely a risky place, but you can also make a lot of gains with that risk. So with the whole market de-risking and trying to find safety, they're not going to find it in crypto right now. So that's something to watch and pay attention to. All right. Cardano, ticker symbol is ADAUSD. I know I don't typically talk about Cardano, but Cardano is outperforming both Bitcoin and Ethereum year to date. And that's really because of the past couple of weeks. Now, Cardano is up 2.9% year to date, while both Bitcoin and Ethereum are down year to date. So it's outperforming. And like I said, Bitcoin and Ethereum. But Cardano, it's been rallying pretty strongly in the last week. And we can see that here on the chart and with the volume spikes way above average, while other cryptos have been losing ground. Now, transparency here, Cardano is my number 3 holding, and Solana would be my number 4. So Bitcoin, Ethereum, Cardano, Solana. Those are my top 4 crypto holdings. Now, I believe this rally may be due in part to the upcoming launch of the DEX Sunday swap. The DEX Sunday swap. Now, Cardano, it has the potential to prove itself here in 2022 and maybe even challenge Ethereum. You know, Cardano opened up smart contracts last year. That was a really nice catalyst for it. Now, it has been in a downtrend, just like Bitcoin and Ethereum. It reached this peak here on September the 2nd of 2021, and it got to a high of $3.09. It's at $1.35 right now. And you can see with this downtrend that since this bottom that it hit on January the 11th, it has been rallying ever since then, except for today and yesterday have seen pullbacks, but they pulled back perfectly to the 50-day moving average, which is the blue line here. All right, so Cardano is one I think it could really have an impact in 2022. Okay, let's talk about Sofi. I am so pumped about Sofi. Ticker symbol is its name, SOFI. Sofi Technologies. I've been dreaming about this day for quite some time. We've talked about it for months, wondering when will it finally happen. And I think we have our first confirmed baby step of SoFi becoming a national bank. So let's talk about this. Now, SoFi, it popped last night when the announcement came out, and there weren't really many news sites covering it. I went to, when I saw the price moving, I immediately went to SoFi's investor relations, and you can find a lot of the information that you need to find on a company just by typing in company name, investor relations, and then go to their press release section. And if there's any news that a company has put out, that's where it will be first. And that's where you can get the not just a news report or someone's opinion, but you can get the actual facts directly from the company themselves. So when I'm doing my research, that's where I go. Company name, investor relations into Google, and it'll usually be the first link. Click on that, and then press releases is where you can find the information you're looking for, or hope to find. Sometimes it's just not out there, especially if it's an upgrade or a downgrade. The companies don't talk about that stuff. But if it's company-related news, that's where you'll find the source for that information. And here it is. SoFi receives regulatory approval to become a national bank. Yes, to become a national bank. Now, I did a post over here on TradingView last night. Since I didn't make a video or live stream yesterday. So if you are on TradingView, come follow us on TradingView because I post there, uh, especially if I don't have a video out. This is where I go and post whatever it may be. Especially if it's chart related, I would definitely post there. It's up over 14 again after hours. Yes, it is. It's up to 1424. And I wonder if we were in a risk on environment, how high would this really have gone? First of all, I don't think SoFi would have been in the $13. And it was a coincidence yesterday. I actually added to my position for SoFi. And then boom, it just shot up. Now, if we were in a risk on environment, wow, this could have really, really gone somewhere. But this changes the fundamentals for SoFi in such a better way. It just gives the company so many more options to do so many different things that it's incredible. Um, it's hard to complain about a 15% day, but after the long wait, it was a bit of an underwhelming response. Yes, that's what I'm talking about. Since SoFi, the market is so beat down. Yep, if it was a risk on market, SoFi would probably be up in the $20, and then this news would have taken it over 30 easily, maybe up to 40. But with a risk off environment that we have been in and have been in now for really this whole year, we have a couple of risk on days, but they don't last very long. It's really been a risk off market right now. And that's hurt growth companies like SoFi. So I've been buying on the way down, and I did buy yesterday as a coincidence because I believe in this company long term. But let's get into uh, what they said in their press release and kind of like what this might mean here. So SoFi Technologies, they did announce that the company will receive regulatory approval to become a national bank. And this is a massive achievement for SoFi. The This is how it is officially worded here. The Office of the Comptroller of the Currency, which is the OCC, and the Federal Reserve have approved SoFi's applications to become a bank holding company through its proposed acquisition of Golden Pacific Bancorp and operate its bank subsidiary as SoFi Bank National Association. SoFi does expect the acquisition of Golden Pacific Bancorp to close in February 22 this year. And of course, they put their subject to customary closing conditions. Now, Anthony Noto, which is the CEO of SoFi, said this incredible milestone elevates our ability to help even more people get their money right and realize their ambitions. And he continued, with a national bank charter, not only will we be able to lend at even more competitive interest rates and provide our members with a high yielding interest in checking and savings, but it will also enhance our financial products and services to ensure they efficiently meet the needs of our members, business partners, and communities across the country while continuing to uphold a high bar of regulatory standard and compliance. This important step allows us to add to our broad suite of financial products and services to better be there for our members during the major financial moments of their lives and all of the moments in between. I'm incredibly proud of our team and excited about the opportunities ahead to help even more people achieve financial independence. Now, last year, in a key strategic step in SoFi's path to obtaining a national bank charter, the company announced a definitive agreement by its subsidiary, Social Finance, to acquire Golden Pacific Bancorp and its wholly owned subsidiary, Golden Pacific Bank. SoFi plans to contribute $750 million in capital and pursue its national digital business plan while maintaining Golden Pacific Communities Banks and bank business and footprint, including Golden Pacific Bank's current 3 physical branches. At the time of the announcement, SoFi submitted a revised business plan for Golden Pacific Bancorp and the OCC and an application to become a bank holding company and for a change of control to the Federal Reserve for approval. After completing the acquisition of Golden Pacific Bank, SoFi Technologies will become the parent company of SoFi Bank National Association. Over the past year, SoFi investors have been hit hard, left, right, and center, holding on to this highly volatile stock. In fact, the stock has continued to move towards all-time lows day after day. That being said, fundamentally, the business continues to perform very well. SoFi's guidance for Q4 21 points towards SoFi reigniting revenue growth rates to 55% year over year growth. This gives investors reassurance during this turbulent time that SoFi is indeed still growing rapidly. Right now, with SoFi's national bank approval, this FinTalk's risk reward profile is arguably the best it's ever been. Period. That's it. So, that's my thoughts on SoFi making this announcement to become a national bank. And what I mentioned about investors taking the brunt, left, right, and center hits over the past several months, it is rewarding, even though we're only up to $14.24. We need to get back into the 20s. When this market changes to being risk on again, SoFi will rise. Because right now, the fundamentals for SoFi have changed. The game has changed. And that needs to be reflected in the stock's price as well. Being down here in the $13, $14 range, this fundamental shift to SoFi is not being reflected, my opinion. And that's why I said the risk reward right now has never looked so good. This is a buy and hold company for the next decade. When they close on the bank, they're going to have 3 physical branches. SoFi Bank is going to have 3 physical branches, not just a digital bank, but physical locations as well. This is such a big deal for SoFi. This means they can get better rates. This means they have more opportunity to expand an already impressive vertical of products and services in a big way. This has the biggest impact that could potentially happen in the history of SoFi. In the history of SoFi, in 10 years from now, in 20 years from now, when the company looks back, this is a pivotal moment in the company's growth story. My belief. What do you think about SoFi becoming a national bank and the opportunities that will afford them? I'm excited, very excited, and I cannot wait for a market that is more risk on to see where this goes. Let's see here. Forecast for Hood and Neo. Well, with I have the deep dive scheduled for Morgan Stanley. So psyched. Yes. Awesome, Devin. Okay, so for Robinhood and Neo. Robinhood, okay. I've got a deep dive coming up for Morgan Stanley in just a moment. I did a deep dive on Jefferies and JP Morgan Chase. There are standalone videos out there that you can watch. The reason I bring up these banks in relation to Robinhood is because fixed income trading for these big banks have dropped off significantly. At Jefferies, fixed income trading dropped 49%. What's that going to do to a company like Robinhood? It's going to destroy them. If trading has dropped off so significantly, then in 8 days, when Robinhood reports their earnings, we'll know for sure what their trading volume has been like. And if these bigger banks are any indication, it's going to be low. They're going to miss the mark. That's my thoughts on Robinhood. I do not have any conviction for the company. I think this can go down even further than it is right now. I mean, it's a $13.93 a share stock right now. And if I go in tighter on this, I think it can go lower. I really do. We are just now maybe at a is this a bottom? Do we get to we got to a new 52-week low today of $13.84. It can go lower. And I don't think earnings are going to help it because the market we are in right now is a risk off market, which means growth stocks get hurt the worst. So Robinhood, I would be sitting if you like the company and thought that, yeah, there's a future. They're changing the game of investing. I get that. I like that. They make it really easy to start investing for first-time investors. I like that too. But it is a growth company. And right now, in a risk-off market, growth is being hurt the worst. So I don't have a good forecast for Robinhood, especially with earnings coming up. It could reveal that trading has slowed. One possibility. Neo, I feel a little different about. Ticker symbol NIO, and Robinhood, HOOD. Now, Neo is a little bit lower. It's a growth company with the CCP right now in China wanting control. The one positive that NEO has in China is the fact that the CCP so far has not attacked electric vehicle companies. It's gone after retail, it's gone after big tech, but right now, EVs are not in their crosshair. So that's one thing positive. The second thing that's positive for NEO is this is a growing company. It is a growth company, and a risk-off environment means it's probably going to trade sideways. It'll have its ups and downs and its valleys and peaks and everything in between. I don't think we'll get a sustained rally until the market switches back to risk on, and not a little flicker of risk on. Like, for example, if we look at NEO here, January 14th was a green day, up 1.54%. That was a flicker of risk on. It wasn't risk on, it was just a little flicker. Because the market right now, I think, is going into a more extended long-term stretch of risk off. That hurts growth companies like NEO. So NEO just had earnings back in November, so we're still a couple months away from any type of earnings from them. They had NEO Day a little while back, so there's no big catalyst for NEO right now. I think it's going sideways, maybe down a little. So that's my thoughts there on Robinhood for you and NEO. I know they're a bit on the depressive side, the negative side. I'm just trying to be as honest as possible. I don't want to get you pumped up and then have you left holding the bag. So if there's one thing that I can do, it is to be transparent and honest. Okay. Long term for NEO, I do like them, but I think a company like, and I don't want to beat up on legacy automakers, but I think Ford might have a chance at competing with maybe Lucid Motors for second place. In my Catalyst Watch video from Sunday, I talked about there's a race right now for second place in the EV market. Tesla, I believe, is king, and I think it is going to survive to be king and the winner in the EV market. But I don't think there's an EV company out there or even legacy automaker out there switching to EV that can top Tesla. So I think there is a race to second place, a race to third place. Maybe we have some a few EV companies out there that make very specific vehicles. But as far as the big dogs go, the winners, I'm not sure if NEO can compete. Maybe it can in its region, but maybe not globally. Just a couple of thoughts there that come to mind. Less inflation, I suppose. Yeah. If inflation does start to reflect down, like I said at the onset of this video, there was a study that I looked at, and I can't remember where I saw it. But it was a study on how the market reacts in market cycles during times of monetary easing versus monetary tightening. And the market actually did better in times of rate hikes and monetary policy tightening than it did with loose monetary policy and interest rates near zero or going down. So I thought that was very interesting. But yeah, if inflation does start to go down, that see, there's many aspects of the economy right now that are attacking us. We have many different types of inflation right now. One type of inflation that we have that will become more built in to the economy is wage inflation, which isn't a bad thing, but we have inflation on goods, right? But we have inflation on the raw materials and we have inflation on labor. And the inflation on labor, that's one that once it goes up, that's really hard to bring back down, nearly impossible. So it becomes more structural. And with inflation, that's one thing that we don't want to see. We don't want to see these different parts of inflation become structural, built in, lasting. But with wage inflation, that means that companies are paying more for employees and they pass that inflation along to the consumer with the product or service also having to go up in price. Well, when cost of the raw materials or the materials used to make these products starts to go down, well, then inflation will start to go down. The cost to the consumer will start to go down, but that wage inflation, that one is really, really hard to go and try to move down, anyways. So you're going to have some sort of this inflation that we see now start to become structural, and the wage inflation is the biggest one. All right. Okay. What other questions? What would it take to ignite a more risk on trend? A correction, number one, because we haven't had a good correction. Let's look at SPX for the S&P 500. We haven't had a really good correction in nearly 2 years. Okay. We go back here to March of 2020. And if I measure this one that happened in September, this one was close. Let's see how low it went. This was a 10% correction right here. That was just getting into correction territory. And then it bounced and rebound. If we look at the next one, because we had a double bottom on this, if we go to the bottom here on this, this was an 8% pullback, right? So we have a 10% pullback and 8% pullback. These were two areas where it was risk off instead of risk on. Then once we bounced and we rebound, risk on all the way up, risk on all the way up. And then we get to September the 1st of 21, and we get a risk off move. And where was the bottom? This was a 5% pullback. So we've got a 10, an 8, and a 5. And then we had another pullback here, right here. And this one went down to, this was a 4.4% pullback. So I'm going to measure where we're at right now. So the biggest one was 10, and we only had one in the past nearly 2 years. The pullback we're in right now is 5.8%. So I don't think we are even close to a bottom. Now that this thing's gotten started, I think this could go back to the top here and go down to where we are right now. 5.8% pullback in the S&P 500 right now. This thing could easily get to 10%. And if we're going 10%, oh, we're a little past 10%. We get to 10%, that takes the S&P 500 4532 down to 4328. That's a 10% move. And that's just under the 200-day moving average. I think it's possible that maybe somewhere between 10% and maybe 15%. So if I get it just here at 15%, that's how low 15% is. And that would take us back to May of 21 to get back to that level. And that's right at the 4,000 level. And that's a good area of support too at 4,000, because we've got these double bottoms here and a pullback right here, double bottom around the 4,000 area back in May of 21. That's where I could potentially see if what we're in right now is going to be an actual pullback, an actual correction in the market, then I think it could potentially go that low. But we haven't had a 15% pullback since March of 2020. And then, and that was, I mean, that was a pretty bad one. March of 2020. What is this? This is 34, 35% pullback. And to go back further, we have to go to September of 2018. And this pullback, this was a 20% pullback right here. So 2018 was the last big pullback, not pandemic related. The March 2020, if we take that out as an anomaly, it's September of 2018 all the way into December of 2018 when we had a 20% pullback in the market. That correction is what I'm looking for this year. I know that's negative. I know that's hard to hear, hard to understand. We don't want that pain. But with that pain comes the opportunities. Because if we go here from this bottom, and I know we can never time the market perfectly, but if we go from this bottom and we ride it all the way out to the rally here, back to this top, this takes us right out of that and back up about 24%. The next little hump, 28%, stays flat. And then finally, that last leg of that rally, and we're up 44%. So it's kind of like how water can destroy, but water can also replenish the soil with good nutrients, or how fires can destroy forest, but then it provides a good foundation and base for bigger trees to grow up through it. So we need these pullbacks so we can continue the rallies, the big rallies. I hope this makes sense. I know I'm kind of rambling here a little bit with this, but I hope it makes sense with this, because we're due for a pullback, a real good pullback. Let's see here. What is the recent pullback on the Nasdaq? Okay, let's go there. All right, it's just taking a second to load here. Here's what it looks like on the Nasdaq right now. And the yellow line, that's the 200-day moving average. And that's what I mentioned at the beginning, that the Nasdaq has fallen below that. So if we take the top rate here and we measure percentage-wise to where we are right now, we're at about a 14%. 14% so far is the pullback in the Nasdaq. Two things come to mind. Number one is the Nasdaq being hit first, meaning that the S&P 500, it hasn't fallen this 14% yet. So could it be that the Nasdaq is taking the hit first? And that's why we have a divide in value stocks versus growth stocks, because a lot of tech companies are growth companies. So could the Nasdaq have a correction right now, leaving the S&P to have the correction in, say, 2 weeks from now? Maybe the correction in the Nasdaq starts to ease first, although with the rising interest rate, that means that the future earnings are worth less. Because as interest rates go up, as inflation goes up, it's complicated. I'm oversimplifying this. But when you look at the strength of the dollar, when those two items are going up, rates are going up, inflation is going up, your $1 starts to become worth less. So that's why I think one of the themes of 2022 is going to be people or companies who make things. People who, or companies, because people are companies, companies are people. They make something today, they sell it today, they can make a profit today. And they have that profit today. It's not that we're going to have that profit in 2 years from now. We're going to have that profit in 3 years, 5 years, 10 years from now. So companies who are not profitable yet, they're the ones that get hurt the worst. And that's why growth stocks get hurt the worst, because they're typically the companies who do not turn a profit yet. Typically, not all of them. Typically. Look at Sofi, for example. Now, with the Nasdaq being down 14%, it's possible that the correction is larger in the Nasdaq because of rate hikes. And then the divide between value and growth just continues to deepen. But the S&P 500, it is due for a pullback just like the Nasdaq has right now. Just a couple of different thoughts being thrown out there. It may sound a bit confusing because I'm not being consistent across indices here, but let's see here. The decline in QQQ is more justified, I suppose. Yeah. Let me pull that up. So here, it's sitting right on its 200-day moving average. This is the QQQ. And if we go from this top right here to sitting on this line here, that's about a 9.3% decline. So 4 or 5% difference between the QQQ and the Nasdaq. The Nasdaq is the one down that 4 or 5 points there, percentage points more so. But yeah, while we're on the QQQ, let's go back. I want to go back to right here. So if we go back to February, oh, hold on. Okay, let me open this up a little bit. Remember last year we had this downturn right here in February, March time frame. It hit the very top of the trend line here, and it got rejected there, and then it fell. And the closing candle, yep, the lowest closing candle would be right here, and that would have been 11.2% decline over 20 days. So it took 20 days to fall 11.2%. This is on the QQQ back in the February, March time frame. And then there was a brief rally, and then another brief pullback, and then a real significant rally, and then traded sideways in April, and then had another pullback, and then May is when things took off. And it ran all the way from May till September. Nice rally. So this, I think, this pullback here, and then a slight rally, a smaller pullback, and then this rally with this double top, and then this pullback. I think that if it would have happened all at once, if this would have pulled back like this and went below its 200-day moving average, then maybe get to a 15% move here, right there. Say 15% move over this 42-day period. It dips below its 200-day moving average. Maybe then we wouldn't have had this big drop off here in February, March, and then another drop off here in April and May. Maybe we would have had one, and then we would have just rallied out of that all the way till September. I think for investors, having that one big correction is easier than having a medium correction followed by a little rally, more pullback, another rally, sideways, and a downtrend again, because you're just not sure where's the market going. Is it going up? Is it going down? Oh, I'm just getting exhausted playing this market. That's what I tend to like, the bigger, the deeper pullbacks, get it over with, so then we can have an extended rally. If you understand what I'm trying to get these thoughts out. So yeah, right now with it sitting on its 200-day moving average, to me, it can go lower, but this is a very important area right here. Now, there's a possibility because the rallies that we have gotten recently, this rally here on January 14th, January 11th, January 10th, there's no conviction in those rallies because I feel like the investors know that there's more pain in the market to come. They're thinking about last February and March, and they're thinking about last, I don't know, last May, where it was down, it was up, it was down, it was up. Let's just go down. Let's just get it over with. Like pulling the Band-Aid off, right? Just grab it and pull. No need to sit there and just go messing with it just a little at a time. Just one big rip. It hurts, and then it's over with, right? Let's have the correction. Let's go down so we can all build back up. Okay. I got way off topic there. Yes, like a Band-Aid. Absolutely. Absolutely like a Band-Aid. Yeah. So there's the market there. Watch that spam there in the chat. Don't click on that. Sorry for all these notifications that are popping up too. Whenever I put a piece up here on TradingView, I typically get a bunch of notifications from likes and comments and so forth. So I apologize for those notifications. I guess I should turn them off next time. I have to remember to do that. Okay. I was going to talk about Ford for a quick second, and then I've got those two deep dives that I want to do, Morgan Stanley and Microsoft. But Ford, right quick, ticker symbol is F for Ford. It was in the news that Ford says that it will record a gain of $8.2 billion on the automaker's equity investment in Rivian. I thought that's pretty cool. So this influx of cash that Ford is getting from its investment in Rivian, that's what's going to help Ford compete with Rivian. It's a crazy circle that that Ford did there. Investing in Rivian building a pickup truck, all electric pickup truck, and RIVN is Rivian's ticker symbol. They haven't been doing very good. Every line that I drew here for them just came to be worthless when the market started to dump on growth stocks. I mean, look at it. It was down 5.1% today. It's down to $69 even right now because it's down another 0.5% in after hours. Boy, this thing, I said months ago that maybe it could hold this $100. Anything under $100 would be a good investment. Right now, my thoughts have totally changed on Rivian, but I didn't want to talk about Rivian too much here. I really want to talk about Ford and that $8.2 billion that they are using from investing in Rivian so they can bring the F-150 Lightning to market. So Ford's going to use that billions of dollars in cash in very strategic ways. I listened to the CEO of Ford talk about this cash and how they're going to use it. He didn't say specifically where it was going, just saying that they would use it very strategically. But the company does plan to reclassify its 900 or so $1 million Q1 non-cash gain on the Rivian investment as a special item, so it doesn't infect or so it doesn't affect their EPS in any way. So that way it doesn't tarnish the earnings per share. Like JP Morgan Chase, their earnings, specifically EPS, is not as high as what they reported. Now, in my deep dive on JP Morgan Chase, I talked about why, and it's because of the billions of dollars that they brought out of their reserves for potential losses, people defaulting on loans that they didn't have to use. Well, that money had to be accounted, so it propped up their earnings per share. So for Ford, this means the gain will not be included in its full year adjusted earnings before taxes or adjusted EPS numbers due to it being posted with the Q4 earnings report. So it's not going to dilute their EPS or tarnish their EPS in any way. I just want to mention that about Ford, because that's a lot of money they're getting from this Rivian investment that they're going to use to bring that F-150 Lightning to market, and then compete directly with Rivian with a full-size EV there. All right, let's talk about Microsoft, Activation Blizzard, and then I want to talk about Morgan Stanley, and then just a couple catalysts to watch for tomorrow. One of them being Netflix. Netflix is liable to come in light on net subscriber growth, so we'll have to see about that. But Microsoft, MSFT is the ticker symbol. And then we'll talk about Morgan Stanley. All right, so Microsoft, it held flat today. Yeah, my drawing skills there. So this, if you don't remember why I drew this, when we looked at Microsoft a while ago, probably back here at the beginning of January, we talked about this, and if it came down here under $300, maybe as low as this $280 level, somewhere in here, this is the entry point for me for buying Microsoft. That's why I have this circled here, and I had this line here to represent the 200-day moving average. If it continued to come down, I had it arching lower, where the actual 200-day moving average kind of just slowly was going up and to the right, and that's because they kind of stalled here right around the $305 area, and haven't really gone below that. So under $300 for me, and I'm a buyer for Microsoft. I'll take these off here. I'll just leave that circle, because in that circle, that's where I would be buying Microsoft. Okay, the deal. This is a huge deal when it comes to M&A, mergers and acquisitions. This is a big one. So Microsoft, it has worked a deal that's worth nearly $69 billion to take over Activation Blizzard, ticker symbol ATVI. And they had an awesome rally yesterday. I believe it got a little stoked today. ATVI. Let's just see how they did today. Yeah, yeah, pretty much flat today. So this big jump, this big gap up right here, when the news broke that Microsoft was taking over Activation Blizzard. And the timing right here, I think is pretty good. Let me just put Microsoft back up here because they're the main dogs here. They're the main players. All right. All right. So nearly $69 billion for Microsoft to take over Activation Blizzard. It is by far Microsoft's biggest ever gaming deal and the tech industry's biggest takeover of another company. And if the deal goes through, it would make Microsoft the world's third biggest gaming company by revenue. That is, of course, if regulators do allow it. They might not. I'm sure they may. But the combination represents one of the broadest gaming portfolios in the industry, combining with one of the world's leading hardware makers. This is sure to draw scrutiny not only from US regulators here at home, but also overseas, regulators in Europe and in China. And it may perhaps take a year to completely wrinkle out all the details. One item of concern is likely the near certainty that Microsoft will pursue making some games exclusive to its Xbox platform. A notable change as Activation Blizzard's Call of Duty has an enormous player base on Sony's PlayStation console. Microsoft does say that it will continue to develop for its rivals' consoles, but you always have to wonder, and I do wonder, how long this will last before slowly some games become ever connected to Microsoft's Xbox platform, leaving out the others. You know, with Activation Blizzard stock under heavy pressure recently, Microsoft had to have seen the writing on the wall as a chance to move its consumer strategy forward. As for the regulatory concern, Microsoft is not under the same level of scrutiny as other big tech companies like Amazon, Apple, Facebook, even Google, for crying out loud. Microsoft is nowhere near under the microscope like they are. And ultimately, the team at Microsoft saw a window to make a major bet on consumers while others were caught in the regulatory spotlight. And they could not go after this asset like Microsoft could. Now, the deal will make Microsoft the world's third biggest gaming company by revenue, behind only two other companies: Tencent, number 2, and Sony, number 1. Activation Blizzard, it struggled over the past year under a cloud of, I don't know what happened in the company, but the employee relations and the allegations of misconduct and harassment, not so good. Its CEO, who was under fire along with the company, will remain in charge until the deal closes. But he's expected to step down after the deal has closed. Microsoft's Spencer will have oversight of the combined operation. The deal is also the biggest cash takeover of the COVID-19 pandemic era, suggesting, and I believe this wholeheartedly, more consolidation could be ahead for the sector, gaming, and indeed, the size of the deal means companies in the broader market are not afraid to deploy cash opportunistically. And keeping in mind this month's other video game multi-billion-dollar mega deal, Take-Two, ticker symbol TTWO, its plan to purchase Zynga. Who might be next? Well, if Activision Blizzard can be bought, then wouldn't that make Electronics Art, EA, the next likely target? And EA is 11.5% off its highs, not seen since the beginning of February of 21. The deal puts pressure on Microsoft's biggest tech rivals as well, not just Sony. But think about Meta Platforms, Facebook, which has dabbed in its own gaming ambitions. One notable thing that I think Microsoft gets with the purchase of Activision Blizzard is a now thriving mobile business. And this is a key focus for Meta Platforms and what looks like a must-have for gaming companies of the future. And despite declining in the initial aftermath of its deal, Take-Two stock has started to rebound, lending a bit of fuel to the chatter that its purchase of Zynga may have been a first step towards its own takeover by big tech. Now, how fast are things moving in video game M&A? Well, Activision Blizzard, it recently talked to a financial advisor about potentially topping Take-Two's $12.7 billion offer of Zynga. Did Microsoft hold Activision Blizzard back from moving further with that acquisition? Will Meta Platforms take a bit of Take-Two? But really, who might be next? Well, that's what I think about Microsoft's planned takeover of Activision Blizzard right now. But I want to hear from you. What do you think about Microsoft's deal to take over Activision Blizzard for around $69 billion? And who might be next? Let me know in the comments below. And remember, your comments make this video so much better. All right. Let me know, seriously, what do you think? Who could be the next gaming company that a big tech operator could take? All right. I totally forgot. I wanted to talk about Gap before I get to Morgan Stanley. Just a quick second here. All right. Sorry about that. All the talking. Okay. Gap. Ticker symbol is GPS. Yep. Just like the GPS that tells us where to go when we're lost. Okay. Look at this retailer. Big gap down from last earnings. Real disappointment. You can see that big hole right there. Big red candle for volume. Just immediate selling. This thing has not been looking good for a while now. I can put this trend line on here. Looks like it was trying to rally there right before earnings. Looks like I need to line it up like that, but there's a bit of a channel I think I see here. Should have done this beforehand so you don't have to wait and watch this. Yeah, there's definitely been a channel here working, a descending trading channel that they moved up to in anticipation of earnings, but then just lost it and fell from the top of the trading channel on the outside to the bottom of the trading channel on the bottom side of that trading channel, just completely skipped the channel. And here it is now. It's recently tapped the top of that trading channel and is on its way back down now. So this could keep on falling, especially with the latest news. So uh, Gap, ticker symbol GPS, their shares continue to gap lower after Morgan Stanley, which we're going to talk about in a moment, downgraded the stock, citing ongoing margin pressure for the year. The stock's price has been beaten down recently amid difficult conditions, having declined by about 38% over the past 6 months. Intensifying supply chain issues have weighed upon the clothing retailer's performance. Now, concerns have also been growing for Gap's peers. For example, earlier in the month, Abercrombie and Fitch, ticker symbol ANF, lowered the midpoint of its quarterly revenue guidance to 1.18 billion from 123 billion due to increasing unexpected and uncontrollable inventory receipt delays fueled by COVID-related disruptions. Meanwhile, various other clothing retailers such as American Eagle, AEO, and Levi Strauss, ticker symbol LEVI, have seen their stock prices tank in recent months. Nevertheless, Gap's supply chain headwinds have been especially pronounced, as highlighted by its share's significant underperformance relative to most of its peers. Supply chain issues were in full tilt during Gap's most recent quarter, evidence in the company's sizable EPS and revenue miss. Also, despite considered consolidated same-store sales growth of about 5% year over year in Q3, Gap's most prominent brand, Old Navy, which accounts for about 54% of fiscal year 21 sales, saw negative 9% comparison growth. The company attributed the lackluster results to inventory delays and to having to resort to air freight to get enough product on their shelves for the holidays. A large component of Gap's business comes from Vietnam, and commentary from other companies with notable Vietnam based operations such as Nike, NKE, and Williams Sonoma, ticker symbol WSM, it could take until quarter 1 before inventory issues improve. Gap supply chain woes are all the more troubling when considering the rise of remote work, which is paving the way for a broader shift towards casual apparel. For example, in late October, Levi introduced or indicated that it believes that casual trends accelerated by the pandemic are here to stay. It backed its bullish sentiment by pointing to growth in its apparel and denim categories exceeding pre pandemic trends. Denim outpaced total apparel for 2 straight quarters. American Eagle in late November also stated that it sees casual wear remaining in high demand. Aside from pure clothing retailers, department store giant Kohl's, ticker symbol KSS, is also strategically transforming its business into a leading destination for casual lifestyles as it notices a shift in consumer taste as well. As a side note, Kohl's is currently sitting in the 8th position out of our top 10 dividend stocks list, or yield leaders, as we like to call them. And you can get instant access to our top 10 value, growth, dividend, and momentum stocks by clicking the first link in the description. Okay, now let's get back to Gap. The analyst downgrade is just another thorn in Gap's side. However, the silver lining is that these issues are largely out of Gap's control, and they could begin to improve as we move through 2022. I mean, they should improve, right? For example, the shutdown in Vietnam have been incredibly disruptive to many industries, but production has continued to ramp up. And companies are optimistic for a full recovery sometime around May of this year. Unfortunately, Gap may have already missed out on fully capitalizing on a solid holiday shopping season, lengthening a potential turnaround in the process. Well, that's what I think about Gap's downgrade right now. But as always, I want to hear from you. What do you think about Gap's downgrade and the margin pressure that Gap is under and the supply chain issues? When do you think supply chain issues for retailers will start to improve? And like I said earlier, your comments make this video so much better. Okay, let's talk about Morgan Stanley, ticker symbol MS. We'll do a deep dive on this bank because, like Wells Fargo, it wasn't all bad. That's right. They were up 1.8% today, flat in after hours, but their earnings were not that bad. Yes, there were some negatives, absolutely. And they are sitting right here on their 200-day moving average. But that's a positive over yesterday when they were sitting well below it. Now, I'll mention in just a moment why I think this happened right here. But look at this. You don't typically see gap down like that in a big institution like Morgan Stanley. But there was a reason for it. Right now, the RSI is sitting at a 37.8. So it's not quite oversold, but it's far from being overbought. As a matter of fact, if you liked Morgan Stanley and you liked where this company was going, right now would be a pretty good entry point. Because if I pull this up, you can see that the second half of 2021, they were range bound and they moved sideways. They're at the bottom of that range right now. So this could be a good entry point for Morgan Stanley right now. Now, of course, yesterday would have been better, but we can't time the market perfectly. Nobody can, and that's okay. All right, so Morgan Stanley. In the aftermath of disappointing earnings reports from Goldman Sachs, ticker symbol GS, and JP Morgan Chase, ticker symbol JPM, and of course Citigroup, ticker symbol C, expectations had been reset and reset much lower ahead of Morgan Stanley's Q4 21 results. It was clear that a steep decline in trading activity, especially on the fixed income side, would weigh heavily on this quarter. As widely anticipated, that scenario unfolded and created a potential headwind, but Morgan Stanley still managed to edge past the EPS estimate while its revenue came up just shy of analyst expectations. Related to most of Morgan Stanley's banking peers, its Q4 results look a little more balanced. Areas of weakness are evident, including the 31% plunge in fixed income trading revenue. And Morgan Stanley's mixed headline numbers represent a major step back from recent performances. However, there are also several key positives from the report that highlight Morgan Stanley's outperformance during the quarter. With the more volatile trading business cooling off in Q4, Morgan Stanley's strategy to become a leader in three distinct financial markets: institutional securities, investment management, and wealth management, that worked in its favor. And at the core of this strategy is the company's recent acquisition of E-Trade that completed on October of 2020, and Eaton Vance, which completed in March of 21. That diversified its customer base and added a consistent fee generating business. In the wealth management segment, which houses E-Trade, net revenue grew by a healthy 10% year over year to $6.25 billion. This is the first time that Morgan Stanley lapped a quarter in which E-Trade was included in its results. Outcomes in the investment management segment are still impacted by the Eaton Vance acquisition, explaining how net revenue surged 59% year over year to $1.75 billion. Higher performance fees also contributed to the strong growth. The jump in compensation expense has been another main storyline for the banking industry this earnings season. For instance, Goldman Sachs and JP Morgan Chase compensation expenses climbed by 31% and 14%. Morgan Stanley kept a much tighter lid on those costs, though, as compensation expense was up just 1% year over year. That allowed Morgan Stanley to generate year over year EPS growth of 11%, while Goldman Sachs EPS fell by 11%. Equity trading was a relative bright spot. Net revenue increased by 13% to $2.86 billion. Although the growth wasn't enough to offset weakness in fixed income trading, which drove total trading volume lower by 26%. Morgan Stanley outperformed Goldman Sachs in this space. Like Goldman Sachs and JP Morgan Chase, Morgan Stanley also capitalized on the robust M&A market, mergers and acquisitions. Its advisory revenue rose by 30% to $1 billion. The strength in advisory eclipsed a slowdown in equity underwriting, which was down 15% year over year, as secondary offerings and IPO activity declined. Overall, Morgan Stanley's investment banking revenues increased by 6%. Sorry, I got a hair there. From over a year ago. Heading into Morgan Stanley's report, most of the bad news was already priced into the stock. That's why you have the gap down and gap down. With expectations suppressed, the company's modest earnings beat is viewed as better than feared. Morgan Stanley, in addition to lapping over or maybe leaping over the lower bar, also stood out through its more balanced approach to its performance, driven by its diversified business model. Well, that's what I think about Morgan Stanley's earnings right now. But again, I want to hear from you. What do you think about the plunge in fixed income trading, not just with Morgan Stanley, but with the other big banks as well. And what about Morgan Stanley's diversified business model? Can that hold up? I mean, it seems to have saved the day. And remember, your comments make this video so much better. All right, let's talk about a couple of catalysts for tomorrow, Thursday, January 20th. First up is a Cathie Wood favorite, Corsair Gaming. The ticker symbol is what is there? CRSR. CRSR. Yep. All right. So Corsair Gaming tomorrow. All right, there we go. Big old downtrend. Big old downtrend. It's still hanging right in the middle of that, just going straight down. Even though it's up nearly 1% today. But Corsair Gaming provides, and oh my goodness, do you think Corsair Gaming could be bought up by a larger tech company? It just hit me. Why not, right? Because tomorrow, I mean, okay, Corsair Gaming, the stock is beaten down, right? Look at this. We've got to go back to the beginning of 2021 to this big old rally. But if we measure, the peak of this, I don't think is really justified, because that was a wild run. And we measure to where we are now, that's a 60% decline. All right, 60% from all-time highs. But those highs right there, up to $49.60. I think that was really manufactured with. So let's just go down to this area here. We'll just call this this split right here. And we'll measure from this right here, this high of $44, $45, down to where it is right now. It may not be exactly fair, but that's a 54% discount. So Corsair Gaming right now, the company is on sale by 54%. That could provide an opportunity for another bigger company to come in and buy them up. It's a possibility. I've got this thing thinking right now about who could be merging together, what companies could be joining forces, what big companies could be taking over smaller companies. It's in the air right now, and I think we're going to see a lot more of it. But tomorrow, Corsair Gaming does provide an overview of its strategy, growth opportunities, and long-term financial targets during a virtual investor day. Corsair could use as many positive updates as possible to get the stock to reverse its trend. And it's been in a trend, hasn't it? And then the second one I'm watching for tomorrow, outside of a few earnings, Netflix, ticker symbol is NFLX for Netflix. Now, if we look at Netflix here, it was trading sideways from June 2020 until August of 2021. So for a year there, just over a year. And then it went on this little run up and run down, right? Okay. Well, it's getting close to the bottom of this bottom trend line for Netflix right now. And it is down. It is down about 26%. This brings it back down to about the midpoint of the range that it was in for over a year. And Netflix has earnings. Earnings tomorrow. What's going to be reported on Netflix? Could we see some disappointing subscriber growth? That's what I'm wondering. With download trends reported to have been down in December across all regions, it's a possibility. UBS thinks net subscriber additions actually accelerated in Q4, but will come up short to management's guidance. So on the conference call, look for color on profitability expectations, because Netflix did say last quarter that it anticipates being free cash flow positive on an annual basis in 2022 and beyond. Given Wall Street's concerns that Netflix will fall short of its Q4 21 paid global streaming net addition guidance of 8.5 million, I believe, hear me out here, that Netflix could stop sharing this metric altogether. Also, the options market. Options market implies a swing of 7.2%. 7.2%. So if we take where Netflix is today and we go both directions, 7.2 up, well, 7.2 up takes us just above this resistance area here. And then if we go 7.2 down, 7.2, it takes us to, okay, that's silly. All right, so 7.2% swing up or down. It's either going to take us to the top and hit resistance, or it's going to take us down to this bottom support area. And that was its range for over a year. All right, so I don't need the options market to tell me that. So if Netflix reports good information, then it could potentially get up here to 554 to 565 in that little range. If it does bad, then it could sink down lower to 477 to 463. Now, if it fell down to the bottom of the range here, depending on what the report said, I think that would be a good entry point for Netflix. Because if we went that far, here, down to the bottom of this range right here, that's a 33% discount from its recent 52-week high of $700.99. So that's definitely one to watch tomorrow for Catalyst Watch. So Corsair Gaming and Netflix. All right. So those are the two that I'm watching for the Catalyst Watch tomorrow. All right. Let me just plug in Bitcoin here right quick. BTC, USD, just to check in right quick. We've been going now for, oh my gosh, 2 hours. Wow. And there's Bitcoin. It's it's a little bit lower than where it was when we started the show 2 hours ago. But there it is. All right. So if you found this video helpful, informative, actionable, then click the like button. That lets YouTube know that you thought this video was fun. Take the URL and share it everywhere you can. That lets other people know you thought this video was good. That really helps us meet our goal of financial freedom for all. Now, if you like my perspective, then click the first link in the description and join as a member. Then you get all kinds of stuff, including our top 10 stocks list for value, for growth, for dividend, and for momentum. And these are updated constantly, so you always have the best names available. So click that first link in the description, become a member, and get instant access. All right, ladies and gentlemen, thank you so very much for joining me. It's been a long one today. Wow. But yeah, that's it. I love the conversations we had, the questions, the answers, it all. So thank you so very much for joining me, and I'll see you in the next video.